David Lowe here, High Ten's Director of Research and Strategy, with a quick David Dials in. On Wednesday, the Federal Reserve announced a quarter-point rate cut, the first since December of 2024, and what could be the beginning of a new easing cycle. Chairman Powell noted the impact of tariffs on pricing during the meeting, but cited the slowed growth of the labor market as the contributing factor supporting a cut. Fed officials anticipate 2 additional cuts this year in October and December. So what does this mean? We've all seen the headlines. For most Americans, this won't shift anything instantly, but there is some cause for initial optimism for consumers who've put off high-ticket purchases or projects like installing new flooring, getting new HVAC equipment, or potentially pursuing a major home renovation. Mortgage rates won't be much of an impact there. Instead, we can look to more clear impacts and really important consumer finance tools like home equity loans. Anyone with a balance on their home equity line can see a slight drop in their interest rates, and critically, new borrowers may consider tapping into their equity to support a big project or a purchase that's been on the back burner for some time now. So what does this mean for businesses serving the residential housing industry? In the short term, we wouldn't expect to see a flood of new demand, but this is a really important signal, and certainly additional rate cuts in the back half of this year will just reinforce that signal, both to markets and consumers, that the peak rate environment may be over. As confidence builds and borrowing costs continue to ease, we could see pent-up demand for higher ticket projects accelerate and unlock in the first quarter of 26. For marketers, the takeaway is really clear. We've got to stay close to consumer sentiment. As affordability gradually improves, the message can shift to let's wait until interest rates come down to now is the time to invest in homes and these higher ticket projects that have been put off for so long. Brands that can connect their value to this moment of improving financial confidence will be the ones that benefit first when spending returns. For marketers, the takeaway is clear. Stay close to consumer sentiment. As affordability gradually improves, the message can shift from let's wait until rates come down to now is the time to reinvest in your home or pursue that large ticket purchase that have been put off for too long. Brands that can connect their value to this moment of improving financial confidence will be the ones that benefit first when spending returns. That's all for now. Talk soon.